Happy holidays, everyone. If you're looking for a white Christmas, it looks like we got a pretty good chance of that this year. If you're not, you should probably book a flight to a warmer climate. My name's Doug Benjamin, and I am the president of the Spencer Bank. I'm here with our guest speakers, Brandon Zimmerman and Jim Higgins with Campbell, Higgins, and Mummert, a local CPA firm in Spencer. Brandon will be our main presenter today, and Jim will be here to help take questions through the chat and provide any additional support. I have a few housekeeping items before we get started with our program. First of all, I want to thank you for joining our second of 3 webinar series covering various tax changes and how to prepare for your tax appointment with your tax preparer. Over the years, we've done several webinars and in-person meetings to help educate the communities that we serve. We are very fortunate to have some great customer relationships and appreciate the opportunity to leverage them to share their various areas of expertise. We're excited to bring you our series today on taxes for individuals. The previous seminar last week, if you were on that or was aware that we were having one, was on businesses. And the final one we have tomorrow, same time, is on farming operations. Today's live webinar is being recorded and will be shared after today's presentation, along with some helpful tips for you to reference. All participants have been muted, and we invite you to use the Q&A chat to enter any questions or comments throughout the webinar. We will answer questions during the presentation and also at the end. So with that, I will introduce our presenter today. Brandon Zimmerman is an accounting graduate of Northwestern College in Orange City, Iowa, and is manager of Campbell, Higgins, and Mummert, PC, a public accounting firm in Spencer. He has worked for the firm for 7 years and greatly enjoys the personal connections he gets to make with local farmers and small town business owners. Brandon grew up in Mesa, Arizona, which is one of the places you could book a flight to not enjoy the snow, but he's no stranger to the farm life. He spent most of his childhood summers in Sioux Center, Iowa, helping his grandparents around their farm. When Brandon isn't in the office, you can find him enjoying a round of 18 holes of at the local golf course, or spending time with his family, his wife Cassie, and their rambunctious 4-year-old son Mason. So, Brandon, it's all yours.
All right. Everyone hear me here? We good, Doug? We good?
Yep.
Okay. Perfect. All right. Well, hi everyone, and thanks, Doug, for the introduction. And thanks to everyone out there for joining us today. We're so excited to have you, and obviously a big thank you to Northwest Bank for putting on this webinar today and this whole series of webinars as well. I know there's a lot of work that went into the behind the scenes work to get all this organized and getting this up and running. So thanks again to everyone involved. So let me see here quick. Perfect. So I want to start out with a quick disclaimer here. Please note that what we cover today is meant for educational purposes only and is not intended to be any type of formal tax advice. Please consult your tax advisor for any further guidance on what we kind of covered today. So what we're going to cover today, the first one there, federal tax law changes and updates. The second one there, Iowa tax changes. There's going to be a lot of them, and there's going to be quite a bit of time we're going to spend here today covering those items. And then if we have time, we're going to take a look at some other Iowa topics that maybe get missed or just easily overlooked. So the first point of discussion here we're going to cover today is changes and updates to the federal taxes for 2022. And by no means is any of this set in stone. As we all know, federal taxes have a way of changing very quickly. We could see changes next month, 2 months from now, but what we have now is kind of what we get. So we're gonna roll with it today. And honestly, not too many changes this year. What I have on the screen here is kind of the main ones we're going to talk about that kind of impact a lot of individuals. And like I said, the federal tax law landscape has been pretty quiet, especially in comparison to a lot of prior years that we've seen a lot of COVID changes. We saw the Tax Cuts and Jobs Act come through. So this is 22 is a very calm year in relation to a lot of those years. So the first change we're going to look at is there is no longer an above the line deduction for your donations. And what we mean by above the line is that if you had, say, for example, $100,000 of income and you had $1,000 of donations back in 21, you could have deducted up to $600 of those donations right off of that $100,000 of income. So that $600, that was a limit for this above the line deduction, and that was available to all taxpayers back in 21. And for 22, that deduction is unfortunately going away. And I don't really want to get into the weeds of kind of standard versus itemized deductions, but just know that you may still be able to deduct your donations if you do itemize in 22. So like I said, if you itemize, you will be able to kind of reap the benefits of those donations. The second point there, the educator expense deduction is going up from $250 in 2021 up to $300 in 2022. Not obviously a significant jump there, but definitely worth the mention. Also, a side note, Iowa does allow a deduction of $500 for 2022. So you want to make sure you don't shortchange yourself when you get to 2022 tax prep here. You want to make sure you put in all your expenses for education purposes. That way you fully utilize the Iowa and the federal deduction there. So the next point we got is kind of a hot topic right now in the tax world, and that revolves around the tax reporting for transactions through a lot of apps that you guys are probably familiar with: Venmo, Zelle, PayPal, those type of apps there. And what they kind of do is, if you're not familiar with them, they allow you to pay people through these apps, and they also allow you to receive payments through these apps. Well, for 2022, these companies, Venmo, Zelle, PayPal, and the such, they're going to be issuing tax forms called 1099-Ks, and those are going to go out to accounts that receive more than $600 of business income through those apps. So, obviously a lot of people that use these type of apps, a lot of them do use them for personal transactions, not necessarily business transactions. So, if I, split an Uber with a buddy, he pays for it, and I just tell him, hey, I'll Venmo you my half. That's not taxable income to him. That's a personal benefit there to him. So, the IRS, they're not trying to collect taxes on these personal transactions. What they're really trying to do is go after businesses that are utilizing these apps for business transactions. So, if a business is kind of taking in a lot of income through Venmo or PayPal, they want to make sure that, hey, you're actually reporting that income and not just, not reporting it at all. So that's kind of the intent of the change. But it definitely is entirely possible that you may still receive 1099-K if you had personal transactions, because we're honestly not sure at this point kind of how the reporting on this is going to work. Like I said, supposedly they're only going to send out 1099s for transactions that are business related, but who knows how that's actually going to be determined on their end. So, if you do end up receiving one of these 1099-Ks, kind of what we're seeing is that you may need to reach out to the company that issued it. So reach out to like Venmo or PayPal and just let them know the issue, and they should hopefully be able to correct it on their end. And if that's not the case, and they aren't or can't correct the 1099, then it looks like we may have to do one of the following: maybe kind of report it as income and then take it off as a deduction, so it's not taxable to you, but we still need to report it. Or the other thing I've kind of seen being thrown around is possibly having a statement attached to the tax return explaining the situation. And kind of the whole idea behind the statement there is so we don't end up getting any correspondence from our good friends at the IRS kind of saying, hey, you got this 1099K, but we don't see that income anywhere. So that's where the statement kind of hopefully helps alleviate that issue there. The next point we're going to talk about here quickly is just cryptocurrency. Again, kind of another hot topic, especially the reporting of it. For 2022 and prior years, it has not been required for these crypto companies to report your crypto transactions on any type of tax forms. So it's pretty much up to the taxpayer to have to report it on their return. The IRS has really been cracking down on this, and starting in 2023, they're going to require these companies to actually report your transactions on a 1099 tax form. For 2022, though, they're still not required to report it. So just be aware if you are dabbling or got some crypto activity for 2022, just make sure you get it on the tax returns. Like I said, they're cutting down on this. The IRS is they're trying to track everything, and you definitely want to make sure to report that on your tax return. Last bullet there, 2022 is the last year for 100% meals deduction. And this kind of applies more to the business side, not necessarily individuals. But the 100% meal deduction came into play these last couple of years, mostly due to the pandemic, to help encourage businesses to continue to purchase meals through restaurants. And then for obviously for 23, that's going to revert back to the original 50% deduction. So unfortunately, that 100% meals will go away starting in 2023. So that kind of covers the federal updates. Not a whole lot there for 22, as you can see. But as I mentioned, federal laws can change quickly. So we just don't know if these are going to stick, more than likely, but we could see changes in the next month or two. It just kind of depends. So let's take a look, see if we got any questions here. All right. First one, if I receive a 1099-K, I report it, but will I be taxed on it? So that is a good question. And as we kind of covered here, the question, you will not be taxed on it if they're personal in nature. And again, if you do get the 1099K and you shouldn't have, because they're all personal transactions, you'll want to reach out to that company and kind of get that whole thing resolved. Let's see, another question here. Based on what you have for, based on what you have shared on deductions, donations will not be tax deductible. Correct. Yeah, so I will kind of go into little details here. The deductions may be deductible. Again, it kind of goes back to standard versus itemized deductions. So I'm just going to go into a little bit of detail here on that. So if your itemized expenses, these would be like medical, property taxes, mortgage interest, donations, and there's a couple others as well. But if all those expenses exceed the standard deduction the IRS gives you, and I think it's around 26,000, I want to say, is the standard deduction for 22. So if all these itemized expenses are in excess of the $26,000 threshold the IRS gives you, then you get to take the itemized deduction total. So let's say your property taxes, mortgage interest, and donations total 30,000. Well, in that case, you'd be able to take the 30,000 instead of the standard that the IRS gives you of 26,000. So good question. Yeah, I don't want to go into too many details on that, but you may still be able to reap the benefits of your donations if you do itemize. So I do see a couple other questions out there, but we're going to move on since this is time sensitive, but we will get back to those questions and reach out to those questions after the presentation or at the end if we have time to address them. So moving on here, and we're going to move on to the Iowa tax changes. And there's a lot here. Most of these changes we'll discuss will take effect on the 2023 tax return, but they will have a significant impact to a lot of Iowa taxpayers. So that's going to bring us though to our first polling question. Which state has the highest tax rate? Well, A or one, whatever you want to go with. 1, Iowa, 2, Minnesota, 3, Hawaii, or 4, California. I will give you a little bit of a hint as you work through this. The answer will not surprise you. Just leave it at that. You know, it is quite staggering when you kind of think of some of these states, how high the tax rates are, and you add on the federal taxes, and if you're also self-employed, you add the self-employment taxes. I mean, the individual could be looking at paying over 50% of their income in taxes in 1 year, and that's just bonkers. It's crazy, but that's what we deal with, and that's where the rates are at right now. So we'll go ahead and see, and good. Looks like everyone, or about 60% of people took my advice here and said the answer would not surprise you there. It is for California. So California has the highest rate, and that comes in at a whopping 13.3%. Iowa comes in at 8.53. Minnesota is 9.85, I want to say, and Hawaii is at 11%. And kind of interesting, all 4 of these states are in the top 10 for highest tax rate states in the United States. And that kind of leads us into the next slide here. One of the biggest changes starting in 2023 is the tax brackets for Iowa. So I've got the current brackets for 2022 for Iowa pulled up here, and you can see just how messy it is. I'm going to get my little laser pointer out here. But we've got 9 brackets going on, and look how quickly we get to our top rate of 8.53% at $78,000 of income. That's all it takes, and we are already being taxed at the top tax rate. I mean, when you contrast this with California's bracket, yeah, 13.3% for California is huge, and that's insane. But the interesting thing there is that California, it takes, I think, over $1 million before you actually hit that top tax bracket of 13.3%. So Iowa taxpayers, though, they're paying this top rate at $78,000. It doesn't take, $500,000. It only takes $78,000, and we're already being hit with a pretty high tax rate. You'll also note here the last bullet there is no different brackets for single versus married filing jointly on the Iowa return there for 22. So, if you had a single person making $150,000, or you had a married couple making $150,000, both those taxing people, I guess, they're both going to pay the exact same amount of tax. And when we kind of look at the federal side, though, that's really not the case at all. We actually get a bracket for individuals, and we have a bracket for married couples. And the married couples is actually a lot more favorable of a bracket because they're a lot bigger and can get up to higher amounts before we start paying the higher rates. So kind of put a pin in that thought, and we'll kind of come back to that. But moving on here, I got the 2023 brackets pulled up. And if we look at my laser pointer out again here, we got a column here for 23, 24, 25, and 26. So if we just walk through this, in 23, the first $6,000 of income is taxed at 4.4, the next 24,000 taxed at 4.82, the next 45,000 taxed at 5.7, and then anything above 70,000 is taxed at 6%. If we move ahead to 2024, you can kind of see that 6% falls off, and our top rate is now 5.7. So again, 4.4, 4.82, and then we reach the top at 30,000 of income, and it's taxed at 5.7. And moving ahead to 2025, you can kind of see where this is going here. The top bracket again, 5.7 falls off, and now pretty much all the income for 25 is going to be taxed at 4.82%. And finally, we get to 2026 when all these tax rate changes kind of stop, and we have officially hit a flat tax bracket. So it doesn't matter if you're making $1 million or if you're making $1,000, you're going to be paying 3.9% on that income. Now, if you recall, I mentioned that for 2022 there are no different brackets in Iowa for single versus married. Well, if you look here at this note here, I got 2 notes here actually on it. But there's going to be different brackets for married filers. So the brackets we have up right now, these are single filer brackets for married. Those brackets are going to double. So that's going to provide a pretty good benefit there for Iowa married filers starting in 2023. And also, worth mentioning, the brackets will be indexed for inflation. And so the $75,000, let's say, for example, $75,000 top bracket there should be indexed for inflation coming up here in 2023 and beyond. And I would expect a pretty good jump in that bracket, or all the brackets, I should say, just because of the high inflation year that we've had. So I would not anticipate that 75 or all those brackets actually staying where they're at. And now most of you may not know this, but the last bullet point there involves a deduction on the Iowa return for federal taxes you pay. So like I said, most people don't know that this is the deduction on the Iowa return, but Iowa has allowed you for many years to deduct the federal taxes you pay each year. So, if you're paying quarterly estimates, or you're paying, let's say you have federal withholding on your paycheck, those amounts that you pay into federal, you actually get a deduction for that on your Iowa return. So it actually kind of, these higher rates kind of misleading, because we get this deduction for the federal taxes we pay. However, in 2023, that deduction is going away. So essentially, yes, we're getting lower tax brackets, but we're losing I'll show here in the next slide, a very valuable deduction. So here, I just want to go over a fairly simple example of how this works. Here we have a single filer with income subject to federal tax of $50,000. Well, on that $50,000, they're going to pay about $4,200 in federal taxes. So as I mentioned, we get a deduction for that on the Iowa return. So we have income subject to Iowa tax of just under $46,000. Using the 22 brackets, we come out to Iowa tax of about $2,246. We jump ahead to 23, when again, this filer is making $50,000, but we no longer get that deduction. We now have $50,000 of income subject to Iowa tax instead of the 45. Even though in 23 we have these lowered tax rates, we're actually paying more in 23 than we did in 22. And that's crazy. But if we get to 26, we can kind of see that now the same 50,000 is only resulting in $1,950. And that makes sense, because now we're getting down to that flat tax of 3.9%. Now it is kind of hard to say when, I didn't run the numbers on this, but when the benefit of the tax deduction does not outweigh the income tax rate changes anymore. I'd probably say, 2024, 2025, one of those years is when the scales are finally going to tip there in favor of the lower tax rates. We do have another example here. Again, the tax rate is $100,000 of income. We got different numbers here, but it's the same story. We got more tax being paid in 23 than we do in 22. So again, the deduction for the federal taxes in 23 at least appears to outweigh the lesser tax rates for 23. So I do want to mention just a quick side note here. This example is demonstrating a single filer. So as I mentioned before, married filers do get that double tax bracket. So it is entirely possible that married filers would see a benefit in 23 as compared to 22 when we look at the difference there between tax rates and the deduction for federal taxes. So that moves us on here to our next set of questions. See if we, let's see, answer. Okay. Let's see. So do you think, okay, so Jim helped me out with one of these questions, but I'm going to answer it live here for everyone there as well. Do you think the tax brackets will change again before 2026? Good question there, and I'm going to go with possibly. And Jim mentioned, as I mentioned on the slides here, they will be indexed for inflation. So we do anticipate those brackets to change for sure. But another point as well to make is that, these tax laws aren't always set in stone. If the out part of revenue kind of, let's say, for example, they don't hit some revenue mark they're looking for or they're looking to hit, they may decide, hey, let's go ahead and adjust the tax rates. Let's bring them back up a little bit so we can generate a little more revenue to kind of help out with that missed revenue mark. So, unfortunately, we're kind of working with what we have in front of us. So kind of long answer short there is possibly for that reason, but for sure they're going to change from year to year due to inflation. So again, we're going to go ahead and move on to the next slide. So the next major point here with these Iowa tax changes is the 100% retirement exclusion. Now, currently, Iowa does allow taxpayers to exclude up to $6,000 of their retirement income from Iowa tax if they meet certain criteria. For 2023, though, they are going to be changing that significantly and allowing 100% of your retirement income to be excluded. So it kind of brings up the question, what is included in retirement income? Well, here's a non-exhaustive list, but 401ks, pensions, annuities, SEPs, solo Ks, and a lot of those self-employment retirement plans, IRAs, and Roth IRA conversions. And a little side note there, Social Security benefits, still not taxable to Iowa. As long as I've been practicing, they have your benefits for Social Security have not been taxed to Iowa. And for 23 and beyond, they will continue to not be taxed either. So just a quick point here, you can kind of see that if you're a retired Iowa taxpayer and you're kind of living off of your retirement income, let's say your 401k distributions you're getting, and then the only income you have is your Social Security benefits, well, you're not going to be paying a single dime in Iowa taxes starting in 2023. So this is going to be quite a big change for a lot of retired Iowa taxpayers, again, starting in 2023. So who exactly qualifies for this exclusion? Pretty straightforward there, 55 years or older as of December 31st, 2023, so the end of 23, or disabled, or if you're a surviving spouse or a relative of someone who qualified based on these above criteria. A little side note there, and as you can tell, I like my little side notes, but there is no income limitation for this exclusion. There is also no phase out either. So if you're going back to that $1 million example, if you're making $1 million or if you're making $1,000, you'll still be able to exclude 100% of that retirement income. So pretty good deal going there. That kind of begs the question, this whole thing kind of begs the question of what income is still taxable? If I can exclude my retirement income, if I don't have Social Security benefits being taxable anymore, what is still taxable? So obviously your wages, so these would be, if you work for an employer, you're an employee, those wages are still taxable, even if you are retired. And the second bullet there, I'm actually going to come back to that one. I want to talk a little bit about that. But the next one, rental income, this could be, a single family home that you rent out, or it could be farmland. A lot of farmers out there in Iowa, so it could be farmland that you rent or something else along those lines. I do have a little note there that there is a possible exception for farm rent, which we'll touch on a little bit later. We just know that's out there. And then last one there, business income. So if you're a sole prop or you're a shareholder in S corporation, things like that, that income is still taxable to Iowa. So if we pop back up to that second bullet there, I've had quite a few clients ask me, hey, I got my brokerage account over at Northwest Wealth Management and wondering if that's going to be excluded from Iowa. I have those funds kind of earmarked for retirement. So I'm wondering if that's going to qualify. And unfortunately, the answer is no, that will not qualify for this exclusion. So these taxable brokerage accounts, they will still be taxable. And these are kind of accounts that you set up and they are taxed annually, or you're taxed annually on all the earnings. So, your interest on that, your dividends on that, your capital gains on that, also interest from any bank accounts you have, CDs, things of that nature. That is also still subject to Iowa tax. So if we move on to the next part here, my favorite part, the best part in my opinion, the tax planning piece of all this. So we got, tax rate changes, we got retirement exclusions. So what can we do to, take advantage of these changes? So the low hanging fruit here, and definitely one of the biggest opportunities, is a Roth conversion. So as I mentioned, Roth conversions do qualify for 100% retirement exclusion. And so that obviously the question there is for a lot of people, what exactly is a Roth conversion? So let's just say you have a traditional IRA account, and the funds inside that IRA account are currently growing tax deferred. So what that means is once you start withdrawing these funds down the road when you're retired, or maybe you're not retired yet, but you want to start withdrawing those funds, they will be taxed at that point. So a Roth conversion, what that allows us to do is take the funds inside that IRA, the traditional IRA account, and tax them now instead of in the future. So when we withdraw the funds down the road in the future, we will not be taxed on them then. So it basically comes down to, if we expect our current tax rate to be lower than our tax rate when we withdraw the funds in retirement, it may make sense to do the conversion, tax the funds now and possibly pay less. So if we can kind of subject these funds, to this conversion starting in 23 via this Roth conversion and not pay taxes now, if we can convert now, not pay Iowa taxes on it now, then that's a pretty good deal there. So if we just look at that quick example I got, just look at my highlighter. Okay, perfect. So that example there, we got just a $50,000 conversion. If we did this, we would have about $4,200 we would pay in Iowa taxes in 2022. If we waited one more month in 23, we would pay $0. So that's pretty dang good deal. As I mentioned here in this bullet, Iowa tax is only one piece of the puzzle. The conversion would still be subject to federal taxes. So everyone's situation is obviously unique. So we definitely recommend reaching out to your tax practitioner before going ahead and pulling the trigger on this commitment here, because the federal side could outweigh the Iowa side. So you might be saving Iowa taxes, but you may be hurting yourself on your federal. So definitely worth looking into on a person by person basis here. And I don't really want to go too much down a rabbit hole here on Roth conversions, but a good question in this situation would be, if my retirement is already 100% excluded, then why would it matter? If I withdraw my IRA funds now versus down the road when I retire, I'm just not going to be paying Iowa taxes on it anyway. So what does it matter? And that is a good question, but it comes back to what we just talked about regarding the federal tax side of it. We are currently in a very low tax rate environment for federal side. We have the lowest tax rates that we've seen in a long time. So if we can kind of push this conversion through now and pay very low federal tax rates, 0 Iowa tax rates, then it's going to possibly turn the tables enough to where it makes sense to do it now, as opposed to waiting until retirement to go ahead and withdraw those funds. And also, when we kind of talked about this, we don't know what Iowa tax rates are going to do 10 years from now. So if you're not going to retire for 10, 15, 20 years, those brackets could be, or the exclusion could be completely gone by that point. So, when you withdraw the funds in 2040, that exclusion may not be there. So just another, again, a great tax planning opportunity there to kind of take advantage of that 100% retirement exclusion there. And the last bullet I have there, I'm not going to spend too much time on this, but it's on Iowa municipal bonds. And if you're an Iowa taxpayer and you own Iowa muni bonds, the earnings on those bonds are what we like to call double exempt. They are exempt from federal and from state taxes. So going forward, obviously starting in 2023, we're going to have a lot lower tax rates. So investing in these muni bonds, we're not going to get as good of a benefit on the Iowa side because our rates are going to be lower. So before we could save, 8.53% on these muni bonds, but now we're only saving 3.9. So that's something to look out for if you got muni bonds in your investment account there. So that brings us to our next question break. Let's see what we got here. Here we go. Are there any other types of retirement income besides the options you had listed? Yes, there are. There are quite a few different retirement options. I just didn't list them. It was a non-exhaustive list. But for the Iowa law in regard to this exclusion, it is very broad. Pretty much any retirement account that is taxable on the federal side will be excludable for Iowa. However, I did recently read up that there was an Iowa policy director that did come out and say that the current exclusion is almost too broad, and that there could be changes coming to that exclusion, coming down the pipeline to that exclusion, where they may only allow quote unquote qualified accounts or qualified retirement accounts to be excluded. And what exactly is the qualified account for Iowa purposes, I'm not sure. But it does at least sound like there could be some exclusions or some more restrictions, I should say, to that exclusion. So there we go. Okay. So I think that's all we have for questions there. So we'll go ahead and move on. Looks like we'll kind of hopefully get through a little bit of this. Let's see. Okay. So now we're on to the next polling question. What's the highest per acre farmland sale recorded in the state of Iowa? A, 22,000, B, 30,000, C, 23,200, D, 26,250. Now, if someone would have put up this slide in front of me 3 years ago, even 2 years ago, I would have said those numbers are just insane. But as you all know, the price of farmland and the farm economy has just, and it just continues to go up, and it just blows me away. Do have my little plug here for my, let's see. So speaking of farming, if you're a farmer or you're interested in learning about tax impacts or tax planning specifically related to farming, be sure to tune in tomorrow to Northwest Bank's presentation over agricultural impacts. It starts at noon, and my colleague Jim Higgins, who is answering a lot of these questions coming through, he will be presenting over that topic. There's gonna be a lot of good stuff there, and really excited to see what he has to say about the farm economy there. So let's see. So we got the poll results here, and it looks like a lot of you are well educated on farmland sales. 45% did guess the right answer of B, $30,000. And that actually, I had to update this slide a few weeks ago because that old record, I think, was D, if I recall, and that was out in Lamar's, I want to say. But in November, a sale came through in Sheldon, Iowa, which is up here in Northwest Iowa, and it came through at $30,000 an acre. Just still blows me away at the price of these farmlands. It's crazy. All right, so moving on here, see if my slides are working here. There we go. So that kind of segues us into the retired farmer income exclusion. I'm not going to spend a ton of time here. I know, like I said, Jim's going to cover a lot of farm tax planning, and he's also going to cover this farm Iowa change that came through. He's going to cover this in more detail, but I just want to briefly touch on it. So you have an idea, and then if you want to join tomorrow, like I said, I'm going to go into a lot more details here. But in 2023, retired farmers will have the option to exclude either one or the other, their lease income from Iowa taxation, or any capital gains from the sale of eligible farm property from Iowa taxation. So let's see. Sorry about that. My slide got a little messed up. So who is who's considered a retired farmer? Well, you got to be 55 years or older or disabled. And the other key there is you can no longer be materially participating in farming. I'm not going to go down that rabbit hole of material participating, but just know that if you're no longer actually out in the field, actually farming, then you may qualify for this exclusion. So again, that's all I'm going to talk about here on this. Again, if you want to tune in tomorrow, we'll go over a lot more details here, and looking forward to that tomorrow from Jim. So moving on, the last piece of the Iowa tax law changes is the employee owner stock gain exclusion. That was a mouthful. I could barely get that one out. So if you're an employee owner of a corporation, you may qualify for this exclusion. Now this one gets into the weeds very quickly. So this one, again, just like the last one, we're going to kind of do a 50,000 foot view. One slide, not a whole lot of details, but just enough so you're aware that this is out there. So to qualify for this exclusion, the corporation or the business had to have been in Iowa and employing Iowa taxpayers for 10 or more years. There has to be at least 5 or more shareholders of the corporation for the past 10 years. And out of those 5 or more shareholders, at least 2 of them have to be unrelated. And the last qualification there is that the employee owner had to have worked for the business for 10 or more years. So if you meet these qualifications, you may exclude the gain from the sale of your company stock. And this exclusion is won't be 100% for 2023. It actually gets phased in over the next 3 years, and kind of in the middle here, we got the phase-ins. Starting at 2023, so next year, you'll be able to exclude 33% of the gain. 2024, you'll be able to exclude 66% of the gain. And in 2025 and beyond, the full gain will be excludable from Iowa tax. So this is probably going to impact the bigger corporations, I say, a lot more than the local businesses, the mom and pop shops. And one of the biggest reasons there, if you look at this second qualification, out of the 5 or more shareholders of the corporation, at least 2 have to be unrelated. So a lot of times in these local small businesses, you see there isn't 2 shareholders that aren't unrelated. It's usually kept in the family. So it may be tough for small businesses to qualify for this. But again, I don't want to go into the weeds here, but just know that this deduction is available starting in 2023. So it looks like we have a little bit of time left, so I will touch on these last couple of points here. These are going to be other Iowa topics. This isn't necessarily anything new that came through with these new tax law changes. These are just items that is a good reminder of things that we see are typically missed or just easily overlooked in the Iowa return. So I'm going to kind of go a little quick through these. Like I said, got a little time crunch here. But the first one, other Iowa topic here, is 529 plans. Iowa does allow you to deduct contributions into a 529 plan. And the deduction for 2022 is capped or limited at $3,522 for 2022. And that is per beneficiary per taxpayer. So if you have, husband and wife and 1 kid, they could each put, roughly $3,500 into their kid's 529 plan and deduct it. So they would get a deduction of roughly $7,000 if they put the full amount in there, up to the deduction limit. So you can contribute more than that $3,522. You just don't get the Iowa deduction for it. And then also, good point here, recently Iowa changed some of their 529 rules. Before, the 529 funds were only allowed to be used for qualified college expenses, and that has been expanded to include some limited K through 12 expenses. And again, that's related to the distributions out of that account. So if you got a 529 plan, you can take some of the distributions or some of the funds out now and pay for some eligible K through 12 expenses. The first bullet there is an Iowa credit that is easily overlooked. It is the Iowa tuition and textbook credit. And if you're paying for K through 12 tuition, textbooks, supplies, so if you got a child, two children, three children, whatever, and you're paying for tuition for them to go to school for K through 12, or you're paying for textbooks, or you're paying for supplies, you may be able to claim a credit up to 25% of the first $2,000 of those expenses. So let's say, for example, you have 3 kids and they're all in K through 12, and you're paying $2,000 for each of them, or $6,000 total. You can claim a credit of up to $1,500 on your Iowa tax return. And that is a tax credit. That is not just a deduction. So a credit is a lot more valuable than a deduction in this case. So that comes right off your tax liability there. The next item there would just be to just a reminder that Iowa does allow itemized deductions as well, similar to federal. And if you recall, when we talked about, I had that question about donations, and we kind of went over the difference between the standard deduction and the itemized deductions, and how if your itemized are higher, you can take that. Well, the federal standard is 26, and the Iowa, I want to say, is only around 4,200. So the Iowa threshold is a lot lower. So you may not qualify to itemize your deductions on the federal, but you may qualify to itemize on Iowa. So just a reminder that, if you're like, I'm not going to get to that 26, still make sure you're counting all those expenses, because you may get that benefit on the Iowa return if all those expenses exceed that $4,200. And the last bullet there is over school tuition organization credit, or STO credits. And that is a very valuable tax credit. So an STO is just essentially a program that helps lower income families send their kids to private K through 12 schools. And if you donate to one of these STO programs, you can get up to a 75% credit on those donations. So just a quick example there, if you donated $1,000 to an STO program, you'll be able to claim a 75% or a $750 Iowa tax credit on your Iowa return. So not bad there. So that's definitely something, if you're interested in donating to that, it's definitely something to look out for. And I think that wraps up everything I have on this material. Let's see if we have any other questions. So I got one here. So I got one here. Question: what if you own farm ground but did not materially participate? And that is a good question. From how we interpret the law right now, you most of the time you will have to materially participate to exclude that, at least that lease income. The capital gain income, that is, I didn't really go over that one in too much details because that gets in the weeds quickly. But most of the time you still need to participate for at least 10 years in order to qualify for that deduction. There is a special exclusion that if you sell it to a relative, you may be able to exclude the gain there. But all in all, in general, you do need to materially participate for at least 10 years in farming in order to qualify to exclude that lease or that capital gain income. Other than that, I don't think there's any other questions out there. Nothing coming in. So thank you all again for joining us today. And I'm going to turn it back over, I think, to Doug.
Yeah, thank you, Brandon. That was great information, and it seems like a year of a lot of changes for the state of Iowa tax laws. So hopefully we'll see some of that stick, but as you mentioned, you just never know, do you?
Yeah, you never know.
Yeah. Well, again, thank you. That was good stuff. And who would have thought that taxes could be that exciting? But you've made it very exciting for us, Brandon.
It's very exciting. I love it.
Yeah. Well, thanks everybody for joining us today. If you're interested, as Brandon mentioned, our ag presentation will be tomorrow. Look for a follow-up email from Northwest Bank to include the presentation recording, That'll be sent to all the registrants, whether you were able to get on or not. Any follow-up material or unanswered questions will be sent out. And there'll also be a survey, and we'd really appreciate your feedback and include areas of interest you would like us to include in the future, and things you'd like to learn more about. So again, thank you. And that concludes our webinar today.